Welcome everyone to our presentation today. Let me ask you a question. Are you looking for a fund that is efficiently invested and outperforms the market? Then let me introduce you to Kryptonite Mineral Exchange Trade Fund, or in short, KMET Fund. I'm going to walk you through our performance last year, and by first looking into the investment policy statement, the portfolio construction, portfolio rebalancing, and performance and evaluation. So let's begin. With the IPS, our fund is invested as a large growth style, choosing to invest in shares of listed companies in the S&P 500. The mutual fund is also set out to achieve many things. One of the goals that we want to do is to generate capital gains in the medium term, investing in a diversified portfolio of listed stocks in the S&P 500, and thus gaining a 5% higher return than the S&P 500. KMET will also be rebalanced annually, or will be rebalanced when there's a major event that occurred, such as a war or a pandemic such as the COVID-19. With our stock selection, we choose to invest in 17 stocks ranging from 5 different sectors. Firstly is energy, secondly materials, and then IT, healthcare, and lastly consumer discretionary. All these sectors contribute into the S&P 500. Therefore, these stocks that we have chosen have a large market capitalization. From our findings, we also found that most of the pairs of stocks correlation do not exceed more than 0.6. And that's our stock selection. Next, we're going to move on to...
So, in order to construct our portfolio, we first take a look at the overview of the US economy. Assisted by new COVID vaccines, accommodative monetary policies, and trillions of fiscal stimulus, the US economy has now recovered to its pre-pandemic trend, with real GDP growing by 5.5% in 2021. Unemployment rate has come down rapidly, declining to 3.9% by the end of the year. The US growth projection is predicted to rise sharply to 7% in 2022, along with the fact that the reopening of the consumer services sector will be likely to face an upsurge in spending, leading to a growing demand for light and medium-weight vehicles for delivery services, as well as gasoline. So now let's move on to analyze the 5 potential sectors chosen here. First of all, energy. The energy sector has become the stock market's equivalent of a speeding ticket. As the world continues to rely on energy to power everything from automobiles to processing plants, it is not unexpected that the global energy market is valued at around $7 trillion. In the first half of the year, energy funds gained 18.4% on average. And secondly, materials. As the country recovers from the pandemic, the US government is investing heavily in infrastructure and construction to spur economic growth, resulting in increased demand for a diverse range of materials. Furthermore, consumers are spending pent-up savings on home constructions and remodeling, causing a rush on materials. Now let's continue with information technology. Currently, the United States accounts for 33% of the global technology sector. As a result, the country is expected to reach $1.8 trillion this year, and tech companies of all sizes can benefit from the US tech sector and expand their operations in the USA. The next sector is healthcare. US digital health startups made more money than ever in the first three quarters of 2020, according to the Centers for Medicare and Medicaid Services. National healthcare spending in the USA reached $4.1 trillion in 2020 and is expected to reach $6.2 trillion by 2028. And finally, consumer discretionary. Consumer discretionary stock prices rise and falls in tandem with the overall economy, with an annual return of 27.2% in 2021, and it was expected to perform well in 2022. The sector was also expected to benefit from affluent households willing to spend on high-end garments.
To identify our asset allocation, we used the Black-Little-Man model. We chose the initial weight for each stock relative to their capitalization against the total capitalization of 17 stocks, and then calculated the expected return implied. After that, we used a Farmer-French three-factors model to estimate the expected return and used it as absolute values to compute a posterior estimate of return. We applied two methods to construct the uncertainty matrix. Is the REX method, which specifies a list of percentage confidences, and the second method, which identifies one standard deviation confidence interval. We also calculated a market implied risk aversion parameter based on market prices to apply in the Black-Little-Man model. The top industry holdings of our portfolio are in energy sector with 34.88%, information technology sector with 23.52%, and finally the healthcare sector with 20.83%. As you can see in this graph, the red star represents the maximum Sharpe ratio portfolio based on our optimization, with the expected return approaching 0.3, while the yellow star represents the minimum volatility of the portfolio.
Now we go to the next part, portfolio rebalancing. Despite the volatility of the U.S. market performance for the last 7-month period from August 2021 to February 2022, KMET had outperformed the S&P 500 index by 3.84%. The outperformance of our fund has been stimulated by the thrive of energy, the material, and the healthcare sector. In accordance with our IBS, we stipulate that rebalancing is conducted annually or when there are major incidents threatening the U.S. economy. Kryptonyte mineral exchange traders fund had decided to rebalance portfolio after the incident of Russia's invasion of Ukraine in this February, which we were anticipated to have a material effect on our asset class because of our performance and good diversification demonstrated in the previous period. We do not make any change in terms of type of stock in our portfolio. After rebalancing, the top three largest holdings are XCA, AMZN, and DVN as shown in the chart on the screen. The top three largest holding industry in energy, consumer discretionary, and healthcare sector. Next, we will do the performance and evaluation of our fund. After 1 year period, KMET fund had outperformed other benchmark at annualized return of 19.31%, while other benchmark had negative return. Due to the highest return and outperformance, our portfolio only includes 17 stocks. Our fund standard deviation is the second highest. Another perspective of portfolio performance should take into account either reward to fatality ratio and other typical indicators. Thanks to our positive return, Sharpe ratio and Trino ratio are positive, while others benchmark had negative ratio. See the change in alpha positive. The active managed portfolio earn an abnormal high return related to risk-adjusted return predicted by the KMET model, and square measure compare the risk-adjusted return of our portfolio and the market portfolio return with regard to the total risk and market risk, respectively. Following that rationale, the K-MET and square were positive, indicate that our manager generated higher performance than S&P 500 index.
Next, let's see our investment style. Our analysis shows that our fund performed well, achieving a 26.34% annual return, and both stock selection and investment style contributed almost equally to the fund's annual return, about 45.64% and 54.36% respectively. As mentioned at the IPS, we have classified the funds as a large growth fund. After assessing the fund's performance, we can conclude that the fund's performance aligns with our projection up to 47%. And nevertheless, we must acknowledge that the fund is still fairly aligned with the large value and small growth size, up to 27% and 24% respectively. Although our large cap growth fund can withstand firmly even during the market turbulence better than the mid and small cap, it still has a certain amount of risk because large cap funds are a type of equity investment, and equity investments are usually considered with very high risk investments. And the fund is more suitable for those who seek long-term equity exposure with a moderate level of risk tolerance. It has low growth and returns on investment as compared to small and mid-cap funds. And besides that, we are required to collect a management fee of about 1% if money is withdrawn within the year.
So, in summary of our KMET fund, KMET has succeeded in exceeding its benchmark and thus generating capital gains in the medium term in the year 2021. This is all thanks to investing in a diversified portfolio of listed equities. To expand further, there's one point we would like to improve. We can see that KMET still has a certain element of risk, even though our large size growth fund is sustained solidly, even in mid-market turmoil better than mid and small cap. That's why we believe the fund is more suitable for people who are looking for long-term equity exposure with moderate risk tolerance. And next point, during the event of Russia's invasion of Ukraine, we made no modifications of the types of stocks in our portfolio, but we did rebalance our portfolio, and with our tactic, KMET has successfully outperformed the S&P 500 despite the volatility of the US market performance. And this also concludes our presentation today. Thank you all so much for listening.